our COBT listeners and viewers, it's Maynard, Mike, and Arjun here with something super special. We have Betty Jiang. She's the managing director at Barclays, covering the U.S. Integrateds and the E&Ps. We've always loved Betty's work and are excited to visit with her. This week is particularly special. It's the last week of summer. Next week is the Barclays conference. It's always the kickoff conference to the fall season. It's a big one. So she's going to share her views about the world, but also about the conference. Betty, we're delighted to have you. Thank you so much for joining us.
Thank you so much for having me here. It's an honor.
Wow, you are too nice. Betty shared she watches the show pretty frequently, Mike, so we can't mess this up. We got to keep her a fan. Mike, what would you tell us about the world before we jump in with Arjun and then Betty?
Yeah, really looking forward to talking with Betty here. You know, what I'd say today, stocks are a little bit mixed. Bonds are mixed. Oil's down about $1.50 a barrel. Natural gas is going sideways. And if you recall last week, Maynard, we talked about last week was really anticipation week, right? Anticipation of what the Jackson Hole meeting would mean for bonds, for equities. And obviously the Fed came out, Powell came out a little bit more dovish. Bonds plummeted a little bit and stock market went back to new all-time highs. And so I would say last week was anticipation week. This week is expectations week. Expectations on what is NVIDIA's results going to look like tomorrow after the close. Everybody is focused on NVIDIA. I'd say sentiment for NVIDIA is very bullish. And why shouldn't it be? Almost every quarter they beat. The last 10 quarters they've beat like 9% on average over the last 10 quarters. And so expectations are high. I just wanted to kind of throw some facts and figures at you. I was looking at NVIDIA's market cap is $4.4 trillion. It's obviously the biggest market cap name in the S&P 500. It makes up 8% of the S&P 500. But did you know this? They're $4.4 trillion in market cap. There's only 3 countries in the world that have GDP that is larger than their market cap. The USA, China, and Germany. Germany is around 4.6, 4.7 trillion. So if NVIDIA beats numbers and if expectations go up, they may be the 3rd largest country in the world by market cap. So it's just really, really interesting to realize that a lot of focus, a lot of anticipation, a lot of expectation tomorrow after the close.
Mike, I'll give you a funny one. We happen to be visiting NVIDIA on the day they hit 4 trillion. So they've added an Exxon since that visit this summer. Like, that's just amazing. Yeah.
Maybe just close with 2 or 3 things. Oil prices kind of seem to be just, is going sideways. They can't decide whether they're more concerned of, a Russian-Ukrainian peace plan. It seems like that keeps drifting to the right. Or what surpluses are going to look like in the second half of 25. And maybe we can talk to Betty a little bit about that. The other thing I noticed that natural gas prices were at $2.75 right now and prompt and basically around $3.45 on the 12-month strip. And this is hard to believe, but natural gas prompt is down about 25, 26% this year. That's more than oil. Oil prompt is down only around 11%. It doesn't feel that way at all. But what I'd say, and I'd love to talk to Betty about this as well, natural gas sentiment, investor sentiment for natural gas stocks are still more bullish than oil. So we could, hopefully we'll get into some of that. The last thing we'll maybe around this conversation out is just note a couple things in the energy land. Last week you had Synovus acquiring Meg Energy, and this week we have basically Crescent buying Vital Energy. The other thing I was noticing this week is yesterday, Trump's Interior Department basically halted work progress on the Revolution, offshore wind project, offshore Rhode Island. That thing was almost 80% complete. Remember, we saw the Empire Wind project, get shut down temporarily, several months back and come back on. So I thought that was very interesting. And, the last thing I want to say is, we really, are thrilled to have Betty today. So I really want to talk about what she got out of Q2 earnings and what she's expecting from Barclays conference that we will be at next week.
Awesome. Arjun, what would you throw in?
Maynard, we're entering kind of the end of the summer period, and we're going to kick off with Labor Day with the Barclays conference that Betty's here to help preview. And amongst the things that, of course, we've focused on at Veridin and at Super Spikes has been on some of these long-term macro outlooks and are critiquing, I think, those that are calling for peak oil demand, peak gas demand, everything. I think everyone knows we push back on a lot of those. But we are going to get some important updates this fall. The first will be from BP. Their annual update comes out in September. The IEA's World Energy Outlook comes in October. And I think we'll leave it to those organizations to update their plans as needed. What I'm going to urge everyone to do is to be wary of language that simply calls for a delayed transition, where all they do is push out the peak by a couple of years and still have a downward trajectory. I'm going to push back hard should any of these kind of organizations come up with that. And I would really encourage people to really dig into these reports and understand what is being assumed of not just global population, but the inherent economic growth. And what is really starting to jump out to me, Maynard, I've mentioned this a couple times now, is for the first time in my 33-year career, the African energy numbers, the African oil demand numbers are no longer an afterthought. It looks like in 2025, it's going to be the second fastest growing continent after, of course, Asia. And that's no small thing. And so we'll see. I suspect African oil demand is actually underreported. Some of these countries use just an incomprehensibly low amount of energy and oil. Some of that is, of course, due to extreme poverty. I suspect some of it's due to underreporting of statistics. I think the last thing, Maynard, is we've weighted in a little bit more than we usually prefer to on some of the near-term supply-demand balances. And of course, if you read the IEA's monthly oil market report, there's a really large assumed oversupply for the next 4 to 6 quarters or so. And I think most people take that and say, well, that's too much, but I'm still directionally bearish. I think that's one of the things that's going to be tested here. We have, of course, spent time digging into OPEC's equivalent report, which does show modest oversupply for the next couple quarters and into next year, but nowhere near as large as what you get from the IEA. I think we're going to see which is going to play out to be closer to the truth. So far, at least year to date, based on where inventories have trended, where oil prices have been, structure of the forward curve, I'm going to say OPEC's winning. And I do find it odd, and this may be an American thing, Maynard, is people understand the debate around the IEA. There's a debate, did they go too far in net zero? Is it clouding their thinking? People understand all that, but they still default to that report. If you say, I've given consideration to OPEC's report, they go, oh, even oil companies, Maynard, make fun of me for giving credence to OPEC's monthly oil market. Well, that's OPEC. They're talking their book. And I suspect as someone who has been in this, lived through a lot of Middle East turmoil early in my life. I remember the Arab oil embargo years. You and I were both at Goldman, I think, Maynard, during 9/11, these really traumatic events that get associated with the Middle East. I suspect this does still skew how people view OPEC. And I'm just going to differentiate OPEC research from what everyone thinks about the broader organization. And you meet the folks there. You meet Dr. Al-Qahtani, who is the head of the research organization. And these are substantive people. And I would just encourage people to give the report a chance, because actually the numbers seem to be working out better when we look at these near-term balances. And just a final point to turn over to you, Maynard, and our guest. I'm really excited to have Betty here with us today. I've known her as a competitor from when she worked closely with Bill Featherston, one of my absolute favorite people who I've known. He was always sort of a Goldman competitor, but a very worthy competitor. And Betty was right there with Bill all these years. And I was excited when she got to take over some of the lead coverage and have her here today. So, man, I'm going to, with that, turn it over to you and look forward to the conversation.
Awesome. Well, Betty, you can see we're our usual enthusiastic selves, made much more so by getting to visit with you today, especially ahead of next week. I didn't mention, Arjun alluded to it, but you first got into equity research, I think it was 2007. So you've been doing it for a while. After a chemical engineering degree at Big Red, Cornell, what has held your interest all these years in the equity research? And is this the most exciting time in energy we've ever had? I mean, honestly, you've seen it for a long time.
First of all, thank you so much for having me here. I'm such a big fan. Your podcast is on my regular rotation, and we really need podcasts like yourself to bridge so many different topics that's impacting the energy sector. So thank you for doing the work that you guys do, and thank you again for having me here. And you're absolutely right. Like, I actually think energy sector is one of the most exciting sectors to cover, because energy sits at the crux of some of the largest debates and questions of our time. Energy transition, sustainability, geopolitics, energy security. Like, there's just so many unknown questions, And energy is such a big part of that answer. I started my career during the boom years of shale. So I've seen the boom.
I was going to say those were pretty fun years too, to be fair. Those were fun years.
Those were very fun years, and it taught me how to dream the dream. Sometimes I tell energy investors that we forgot how to dream, having been in the trenches for so long now. But I think early days of shale was certainly very interesting. And then did a couple of years on the buy side. But what really opened my eyes is my 3.5 years doing ESG and sustainability research, and realizing how important energy sits in a lot of the sustainability debate and how complex the equation is to solve for how we're going to source and how and where are we going to produce the energy the world needs. So I do think energy is in a more exciting time than ever before, and that's why I'm back covering the oil and gas sector.
You know, it's interesting. The reason I have this fancy background, I'll confess, we went to Hawaii, but while I'm here, I learned they're using oil to generate power here, and it's a sustainability kind of paradise. So it's just to your point, you got to get into these systems to really understand the effects, and energy is always at the heart of it. In our pregame, Betty, when we were catching up with you, convincing you to come on the show, you mentioned that ESG experience you had, the sustainability experience, was particularly helpful to your problem solving, to how you thought about systems. It really gave you, I don't want to put words in your mouth, but it was an experience that helped you, your analytics more broadly. Do you mind commenting on that? I thought that was fascinating.
Yeah, no, thank you for that. You know, it's interesting. The first year of ESG was really a struggle because trying to understand the acronyms and what really ESG is. And then the more you dig into it, the more you realize how complex the problem is. So ESG or sustainability, for that matter, helped to hone my research skill set to have a very open-ended question and have the world as your resources to dig into that topic and hopefully try to come up with the answer. So that certainly made me a more resilient analyst, for that matter. But from the energy perspective, it really understands the complexity of it all. To understand energy transition, we need to know policies, consumer habits, energy security of the different countries, and like Arjun was just saying, how Africa experiences their energy consumption and growth is very different from the U.S. or very different from China, and every single part of that is a complex equation. And I also think one thing is that the sector lines are getting increasingly blurred. Now, we are so focused on individual sectors and the company that we look at and how we traditionally do research. And you realize it's very important to look across sector, because to solve the problems of the future, all the sector needs to come together and work together to help. And it really just broadened my lenses on how to approach research.
It's funny, I hadn't thought of this until you put it like you did, Betty, but that's kind of why we, as old, longtime energy nerds, why we love the platform here so much, is we get to talk about so many things. Our joke is almost everything is affected by energy, so it's not limited. Maybe one question from me, Betty, and we'll get Mike and Arjun in here, is you mentioned that the sector's coming together. And in some of your research, I noticed that you shared with us, for instance, you were working with a research analyst who covers, I guess it's industrial or manufacturing. For instance, he covers GE Vernova, and you guys wrote a report about turbines and the backlog of turbines and what your read through is from all that. But it was illustrates your point about connectivity, but also just a research department working together across sectors to come up with some views. Do you mind talking about that report or anything else like that you're doing?
Sure. So in my sustainability role, I often felt like it was chasing cats. To imagine trying to come up with a view on the impact of the IRA climate policies and need to pull together the expertise. We ultimately ended up being able to put together 20, 30 analysts. And that's the best way to have an in-depth view of what that policy does to the economy. And then each sector learns from each other. But that collaboration work is difficult to do in this day and age when everyone is just busy with so many things on their plates. So being in a role to pull that together and the cohesion in the research department is very important. So the culture of the research department is important. I'm lucky enough to work in environments where people are collaborative. And most times you don't have to convince people to, at the end of it, to realize that there's more value being working together than working independently.
Yeah, Betty, I was looking through one of your pieces. I was basically titled "What You Learned from Second Quarter Earnings Season," and I think you had 6 different subjects, but I really want to kind of hit on 3 of the themes. I mean, U.S. oil production remains resilient. The second one was shale efficiency shows no signs of slowing. Gas power momentum is accelerating, but pricing is unsure at this point. And basically, market is rewarding free cash flow this last quarter. Maybe touch on 1 or 2 of those areas where you think that there's some differentiation, and maybe somewhere where investors are really focused on one of these 3 areas.
Sure. So let's start with free cash flow. I actually titled one of the subtitles as "It's Free Cash Flow Galore." I think this last quarter might just been one of the best earnings seasons in recent memory. We have companies raising free cash flow left and right, in large part because of one big beautiful bill that the tax benefit really boosted the free cash flow, not just from this year, but for the next year. And for some companies, cutting that tax bill for as long as 10 years. So it's a very meaningful benefit for the sector. And we've seen that free cash flow going up 10% for 2026 and high single digits. So it's durable free cash flow improvement. So as a result, that's really been a key highlight from the quarter. And on top of that, you mentioned shale resilience and production resilience. And I think that is a key theme that has been flowing through the last few years. We're almost taking it for granted now that excellence is just expected. The fact that the company just keep on doing more with less or delivering the same production with fewer rigs, fewer crews, lower capex, it's just that's just what the companies are doing. So in some ways, you're not even getting a blinking in an eye because efficiency seeking has been such a recurring theme in the sector, but certainly that's helping the underlying cash flow generation of the sector as well. So all of that sums into shale is more resilient than people think. With the free cash flow benefits from the cash flow benefits from the tax bill, we think the oil price break even to cover capex and base dividends is below 50 now, and on average, and that means companies are not going to change activity unless oil falls down to 50, 55 in a sustained basis. And at $60, they're just doing perfectly fine. and $70, they're doing very, very well. So all this talks about, oh, shale is going to roll over and probably there's just a lot of distress. We're not seeing that from the upstream companies. And we are also not seeing that from the production. I think at best we'll probably see production hitting more of a plateau next year over the next few years, but we are not grabbing to the view that production is going to roll over. Unfortunately, on the gas side, gas production has also been more resilient. We're seeing more gas coming from oil companies and better efficiency from gas companies. So that's also been hurting the gas macro in the near term, that because of the more resilient production coming out of Haynesville, coming out of Woodworks, that's why the front month gas price is back below $3 again. That said, we do think this time is different. The demand signals for the gas sector is durable for the next 3-5 years, driven by both LNG and power. So we're still bullish on the gas equities. But I think the production resilience is definitely there. But I would say the gas power theme is probably the biggest secular narrative in the space, which is why investors are still bullish on these names.
Maybe some thoughts on the gas power. We were talking to an E&P management team today, and we've talked to a bunch of our partner companies, and it feels like they're in the early innings of understanding what this is all about. Trying to understand how the power markets work. How, from the standpoint of how you approach these things and how these E&Ps approach things, what's the type of collaboration you have with your sort of power team, and so you can understand what's going on and maybe translate that to investors? And how are companies? Are they early in the innings? Are they trying to understand this as well?
Yes, absolutely. I'm talking to our utility analysts, the clean energy analysts all the time to just having a grasp of what's going on. And I had because of my background, I probably have slightly bit more head start just understanding the grid and realizing how complex everything is. The early days of AI, people will say, okay, what does that mean for gas demand? Like, there's so many factors to understand what grid you're talking about. Is it PJM or is it ERCOT? What for that grid, what resources is being produced into that grid? What is the climate regulatory policy governing that grid? And how are we going to add capacity into that grid? So in the early days, to understand power, we actually did a big report on PJM, because in order to understand and gain conviction in the power demand in Appalachia, we need to understand how much stress is the PJM grid under. And coming out with a conclusion is that there's so much distress in the PJM grid today that even before all this growth in data centers, we need more baseload gas power just to replace coal. So there's no way this power, data center power demand is even going to get built without more gas demand. So there are just things like that that I think we just approach it in a different way. And then talking to our utility to analysts, talking about, wow, this like capacity auction prices is just through the roof. And that's going to be beneficial for both utilities and the gas supplies that's going to power those.
What you just said was fascinating. It's basically like AI shook us out of our sustainability mindset. Like AI, if it hadn't been for AI, that might have gone on for a number of additional years where we kept debating what works, what doesn't work. And now is that a fair way to think about it in your mind?
I love that you said this, because what is the catalyst for things to actually get done is when there is economic incentive involved. And that's like, we need to solve a problem because we need to make money with AI. And as a result, capital flows, and system is going to get created to enable that. And that's exactly it, because tech needs power. We need to solve for that power. As a result, we realize that we need baseload power. And because nuclear is still 10 years away, that means we need gas. I am a bit disappointed that all this talk about sustainability and tech supporting the energy transition is not translating into their willingness to pay for low carbon gas power. So Exxon said on their latest call that they think the greenfield gas power with carbon capture is coming in slower than they thought. There's still a lot of discussion with tech companies and about their willingness to pay for the low carbon piece. And clearly the business incentives are saying, right now we just want the power. They're still a bit price sensitive, and then they're not willing to pay for low carbon because the technology, the willingness, and the capability of the energy sector is ready to provide low carbon power with gas power with carbon capture. That's ready. Exxon's willing to do it, but they're saying the demand is coming out slower than they think. So that's disappointing to me. And but still, what we do know is that gas power is definitely needed.
I'm actually going to extend on these themes that Mike and Maynard were asking about. I think this idea that the irony I find in what you just said, Betty, is it's typically the oil and gas companies that get attacked for not being, sufficiently sustainable or partners in the energy transition or whatever the language that had been used. And the tech companies, all of whom are from California, were sort of most front and center. And I think your point, if you don't have an estimate, it's fine. But how much would carbon capture on average add to the cost of a gas power plant? Do you know that?
It really varies.
Yep.
Again, it varies where you put it. So if you put it on the Gulf Coast, it's cheaper. You're closer to sequestration. So the sequestration cost will be lower, but there's less incentive. But if you put it in California, you get 45Q tax credit. You get California tax and avoidance of carbon taxes. You got LCFS, so the incentive is better. So I don't have an answer for you on exactly the spread, but I do know that my rough thinking is that to put a carbon capture on a new build gas power plant will probably double the cost of the capex.
Yep.
And but that doesn't mean doubling on the power price. But but it's about solving for the price, what it takes. But back to this, what you said about energy sector are actually leaders in enabling the solution. They're absolutely ready and willing and eager to provide the solutions if the market is there. The problem is the market is not there because the policies and the consumer willingness to pay a premium for low carbon is not there. So to blame the energy sector for not transitioning that's just the wrong way of looking at it. I have always think about it like it boils down to cost of carbon. At the end of the day, it's about an explicit or implicit cost of carbon. And the best thing that could happen to the energy sector is if we just put a universal carbon price in the world, and then the market would decide what's the best way to decarbonize. That's never going to happen. That's wishful thinking for sure. But right now, only 25% of the global emissions is getting covered by a carbon price at a carbon price of less than $20. And that's just not enough to decarbonize it. And as a result, energy transition is not going to happen because the market incentives are not there.
Hey, when I think about the gas and power theme and the II theme, and let's just see, we take it as a given that there's going to be significant growth over time. There'll be ups and downs along the way. I think for the largest company, you gave an ExxonMobil example of being willing to provide carbon capture and power and so forth. For some of the non-large cap E&Ps, mid caps, I kind of share your view that gas production itself is very resilient. So I feel like you can have a bullish gas demand story, but not necessarily a bullish Henry Hub story. How should they play power, if at all? And maybe it's not just the mid E&Ps, even the larger companies. What is their role in this power theme?
So you're right. We have to be very selective of which sources to get exposure to this theme. And what we are seeing clearly is that Appalachia is getting more momentum on this power theme, where that for the first time this quarter is getting translated into explicit supply demand agreements and gas supply agreements. And EQT signed 1.5 BCF per day just from 2 deals. And what's showing me is that scale, investment grade balance sheet, the strategic integrated midstream platform that they have is enabling them to be the winners of these deals. If we have yet to see who are the other ones that will benefit from this, I think at a large scale, it's the companies in the right place with the right capability that will benefit from signing these deals and get margin expansion from a gas realization uplift. For the rest, it's a function of IMAX and what this means for gas demand long term. I do share your view that we're more likely to see gas price volatility than absolute gas price appreciation in the long run.
Betty, Mike mentioned earnings, and it was so interesting, your comments about this past earnings season being one of the best in a long, long time. It's a practical question. How do you keep up with all of those earnings calls? How do you distill all the information? How do you survive earnings season? We watch. Mike is dutifully listening and reading all of it himself, telling the rest of us what's going on. But just how do you make it through the earnings season?
Well, thank you for that question. But Arjun knows as much as I do about the grueling hours of earnings season. I do think I'm not going to count how many earnings season that I've done it for now, but it's keeping up with it. It's just part of life as a research analyst. I think there are more tools today to help synthesize and understand and then understand the common themes across different companies. But it's a grind through earnings, which is why we like to summarize it towards the end by the end of the earnings season and just look at and assess, hey, where did our numbers go pre and post? What are the bigger themes that came out of the sector? And then try to come up with a more differentiated view for our clients.
Now, you mentioned these tools. I have to ask, are you using AI or what? Or you don't have to give us all your secrets, Betty, but because also in this world, you alluded to it, you'd love to know what GE Vernova said on their call or what Westinghouse said on their call or what Caterpillar said. Like, you're trying to keep up with, mentally many flavors that could be relevant. Like, any tips you can give the rest of us for keeping up with all this stuff?
Well, we're a learner of this process ourselves. I do think AI is changing how research work. In some way we have to, because AI is impacting how research is being consumed. Very quickly, our clients, right after earnings report comes out, they will already get a AI generated, this is the result and this is how you compare to consensus. And this is where street is versus the reported numbers. So how do we add value above and beyond what was just reported? So the boilerplate things, it's just not going to work. But how do we keep up with it? It's still it's a learning process. I think the tools that's being made available for us, whether that's AlphaSense or other news digest, is able to distill things into key topic areas or theme of interest that they will be able to flag some headlines for us. But I still think at the end, to dig a bit deeper and synthesize into the most important points, we'll have to go into the transcripts and then the releases themselves to understand the context and reference a lot of these AI headlines.
So Betty, I'm curious, there's probably, I know there'll be a number of companies watching this. You have a lot of fans out there. What would you tell them about, quote, a good earnings call? Or what do you notice about when you, obviously what matters is the substance, but what would you say just as a consumer of earnings calls for many, many years, when one is good, or when the dialogue is good, or when the Q&A is good, or how do you have a good earnings call over and above just obviously hitting the numbers?
Sure. So I think the earnings calls are certainly evolving. The earnings calls of spending 30, 40 minutes on a presentation and walk through slide by slide is shrinking as a percentage of the calls. We have some calls that go straight into Q&A, which I appreciate, because by the time we are listening to the call, the market would have digested all the material that's being released and already have an early view on what are the key issues and questions related to the release. So spending more time fielding Q&A is a more useful for everyone's time. And then that Q&A, now every transcript, whether Bloomberg or AlphaSense, will get summarized and AI synthesized into this is the key topics that's being discussed in the calls. But I find that sometimes it loses the nuance and the tones of what's being said. So it's helpful to understand what are the companies what are the companies or the topics that got hit on the most. But some of the in-depth reading, I still think is required for people like me doing the deeper coverage.
Betty, it seems like this is more of a public company question, outside of just E&Ps and the integrateds that you cover, but just, public companies are always faced with these issues of, we believe a certain thing about where the world is going. We believe a certain thing about what's the best way to make money for our shareholders long term. And there's always a tension around, will our shareholders embrace that? Or do our shareholders agree with this? Or this might be short-term unpopular, but we really think long-term is, quite a wise move. And then, of course, all shareholders are not the same. There's some who are super short holders, and then there's longer ones. How, as a equity research analyst, if you were to think about a company doing something which is probably not going to be popular day one, but might have merit in the longer term, like how would you address a board or a management team thinking about that kind of issue?
Wow, that's a great question. And it's sometimes really opens up this whole, my view that energy sectors and companies, management teams of the energy companies are probably the toughest sector from competing demands from various stakeholders and shareholders of the company. And you can never please everyone. And I have come to the view that it's less of a pressure now, certainly with ESG fading into the background, but you can never please the ones who care about transition, or shareholders who care about the transition and wanting company to invest into new emerging areas versus your traditional oil and gas shareholders who just want shareholder return and more buyback. And a company would just have to set its own North Star, communicate that North Star, and be consistent in that messaging. And you explain why is it that you're doing certain things, what is the trajectory of, even if it's not popular, say spending money today on a new venture that has a lot of uncertainty that you don't know. I don't think that will get embraced very well by oil and gas investors, but sometimes maybe that's necessary, but at least communicate what is the rationale for such an investment and what is the trajectory to generate profit and return on these type of investment over time, and what is the scalability of that business. But I think having that your own North Star and consistency of message is very important, because you will never be able to please everyone, and you just have to yes.
That's good. Mike?
Yeah, Betty, I was really kind of thinking about investors, right? I mean, what do investors look like right now? What kind of, who is basically coming to energy? Who's leaving energy? What is the sort of hedge fund versus, active money versus passive money look like? Has that changed over the last couple of quarters? Do you think it will change given a lot of these, long-term secular themes you talked about?
I wish I can tell you things have changed, but I still think energy sector is a bit of a knife fight with shorter term investors who are very invested in the companies and looking at pair trading good and bad companies of very similar exposure. There is no denying that the sector is out of favor with generalist investors. And for them to come back to the space, they really need to see a tailwind, macro tailwind, or a secular thematic tailwind, which is why there's a lot of long-only interest in the gas names, because of the duration of the theme, and that checks many boxes. And so I don't think that has changed much to date. I do think the energy sector is offering better value proposition for investors than ever before. There's concern about inventory duration or the sustainability of free cash flow, but we're in the 9th year of capital discipline and 7th year of meaningful cash return. Like, they have changed. The company are very much committed to discipline and returning cash to shareholder. And the last few years is showing that there's more resilience in their capability to continue to do that. And they have shown to the market that they're doable. Like for my coverage, on average, they can buy back or return 20-25% of its market cap in 3 years. And that number has been more or less the same since the last year or so. So it's a matter of time of waiting for investors to come back and to really see the attraction from the sector. And I think the companies are ready to show that that what they are generating and delivering today is sustainable.
I think one of the things that over the last couple of quarters has really stood out to me is just, this issue of return of capital. I mean, how much capital is being returned through share buybacks versus how much is being returned through debt pay down and stuff of that nature. And I don't think there's really any qualitative or quantitative data that can tell us that one is better than the other like this. I think it's just more of like where you are in the cycle from an oil or natural gas is where people kind of go to. But it really kind of feeds into what Maynard was asking a little earlier is it doesn't seem like investors, everyone's being grouped together, give or take a little bit, because balance sheets are generally in good shape. It almost feels like you have to have a story, unless you're a large cap name or sort of a micro cap name that has some specialty. You have to have something that's differentiating yourself. So is that true with investors? And if that's the case, why are more management teams not basically trying to differentiate themselves either through, whatever?
Yeah, so when I came back, one of the things that people asked was one of the key things you have to figure out is how to differentiate companies, because E&P at a very high level is starting to look very similar. And at a high level, yes, because everyone has, it's shale companies with different variations of duration. But I started with a mental model of just saying, what are the companies come 2030 would I still be very excited about and about their portfolio, that they would be better 5 years from now than where they're today. And that plays to what you were saying about the theme and the story. The story is enabling for whether that's some growth or some thematic angle that the company there's a better rate of change that they might be more excited 5 years from now than where they're today. And I think that's where the company needs to show that differentiation. What's unfortunate, I think, is the market is not particularly rewarding that differentiation because we're so focused on this year and next year and how much cash return you can give me now. We are not failed to differentiate a company that's spending 25% of its capital into major capital projects that's going to make them better 3-5 years down the road versus one that's just maintaining capex production and paying out everything. So there's still not enough of that differentiation long term, but you do see that differentiation if you're willing to look longer. And I think companies are starting to hammer those messages more frequently to say how they vary from their competitors.
But I wanted to build upon this theme of differentiation, and I realize it's going to matter by company, this is going to be a generic question, but in terms of differentiation, most investors absolutely hate diversification. There's nothing they hate more than I'm in these 3 things, I'm going to go to this 4th thing. It is something I advocate for, and when I do it, I say, I know all investors are absolutely going to hate this the second you do it. But you cited the EQT example earlier of they did a midstream integration. They might have had some questions when they first did it, but now seems to be, as best I can tell, working out for them. Whether it's upstream oil, I'll try and make it generic to not have to put you on the spot for an individual company. But how do you think about companies going to new areas? I agree with you, shale is resilient, but resilient is not the same thing as it's a new source of necessarily opportunity and a way to add differential value. How do you think about diversification for your companies, excuse me?
Yes, and you're absolutely right. Investors don't like change, but change over time is inevitable unless you're just looking to sell yourself. And that, I think, is what puts management in between a rock and a hard place, because it's very difficult to meet demand. Because if you go into a new basin, that's not great because there's no synergy. So why? And that creates more questions about your current things. And God forbid you start a new business in an unknown area, low carbon, and say, wow, that's money just going out the door for something that I don't quite understand. I don't know how I'm going to get paid for. And you get discounted as there's zero value for these ventures until proven otherwise. So, but you could use that as a perfect example of when they first did the midstream deal, that was received poorly because that was new and that made the company more expensive and levered up the balance sheet until proven otherwise a year or two down the road that it gives them that differentiated capability in grabbing these power deals. So I don't have a great answer for you because I do think that's a difficult piece that management have to solve. And then I go back to the whole North Star. If a company thinks that is an area where they see competitive advantage, believe in it, sell it, and deliver and execute on that vision. But you have to lay out that vision, but you have to do it smartly. I use CRC as an example. I think they are leading in a lot of ways in trying to build a carbon capture business in California, where they're the only one in that business. So finding a creative way to find a financial partner to help them fund that CCS growth is kudos to the management to think outside the box. But still, very little value being assigned to that business until proven otherwise. So it's a difficult ask for management for sure.
I like how you describe have your North Star, and if you believe in it, do it. That resonates with me, and I hope companies will take you up on that advice. I'm going to tag team with Maynard here because we're only somewhere in the 58 or 59-minute mark, and we actually want to talk about the conference. So key themes, what you're looking for. I think we've got some of it from you. Clearly, gas, AI, and power is going to be a theme. The shale resilience is something you believe in. I think we expect to hear that. The commitment to returning cash to shareholders. But aside from those things that I think are the big picture items that most people are expecting, what are a couple or three things that you think might stand out or that you're specifically looking for within all that?
Yeah, well, we actually did cover a lot of things that I wanted to hit on the thematic point, just how efficiency gains and everything that we're hearing so far is going to translate into 2026 outlook, how the increased free cash flow that's being generated now with the tax savings is going to come back to investors, whether through buyback or using for debt reduction. The gas power deal is a big theme. I do think gas is it's an interesting setup for the gas names into the second half because after a lot of near-term concern and negativity on the production resilience that gas prices have pulled back, but the structural demand story is still intact. I think, in fact, the worse it's getting now, it might actually make it better for a 2026 outlook because all these concerns about adding activity back and seeing private start adding rig count in Haynesville is all going to slow down. The concern about power gas to coal switching because gas was too expensive is going to reverse. So I think the sector, the conference is set up for the gas companies to come up with a compelling pitch on why the thematics is still intact, and this is an opportunity to look at the gas names again. And M&A, we touched on it briefly, but I think that's always an enduring theme for the energy sector. I think rather than just focusing on scale and the industrial logic, I think more companies is looking at strategic value of M&A, like Exxon's talking about their proprietary technology to unlock more unconventional value, being able to double the resource recovery, or like EQT with their midstream, with their recent deal that adds to their capability to get power. So sort of listening to the companies and what they think is the M&A landscape and where they think is the best opportunity is certainly an area we're always listening for.
Betty, I don't usually ask about specific companies, but it was interesting that Darren Woods was talking pretty openly about being interested in acquisitions. I can't remember exactly the quote. Did that surprise you? What do you make of that? It's kind of interesting to be talking that way.
Yeah, it's in some ways, it has been one thing that got picked up during the earnings season. But the message itself is very consistent with how Exxon had talked about M&A before. I do think it may sound a bit more proactive that they're seeing opportunities across all segments, not just upstream. So there might be things in product solutions or downstream or emerging areas we don't know. But what did stand out to me is how Exxon is doubling down on their message on improving resource recovery and the proprietary technology advantage that they're able to apply to unconventional. And what's also interesting is Oxy is echoing similar theme that they think CO2 floods for unconventional works as long as you have CO2, and they're already working on pilots. So these are the things I think makes me think there will just be another leg to U.S. shale, that the industry is finding ways, maybe things that we don't know now. AI, actually did not mention like the whole, how the industry themselves is using AI to help them get even more efficient, improve base optimization, reduce downtime. All of that is another angle in sort of the next chapter for the energy sector or for the U.S. space.
Well, as we wrap up, what are the just raw numbers? We know next week is huge. Mike's already got his bag packed. He's coming to New York. He's so excited. But how many investors and companies roughly will you guys have next week?
Well, so far, the latest count is over 170 companies across the entire energy value chain, from upstream down to utilities and clean energy. And we got over 1,500 attendees that's scheduled to come. So it's going to be a big week, busy 3 days for us, but I'm sure we'll be learning a lot on the back end of it.
Well, Betty, thank you so much for the hour. It was great spending time with you. And please come visit us in Houston. And if we can ever do you any favors, give us a ring. We really enjoyed the conversation today.
So the pleasure is all mine. And absolutely, I look forward to seeing you in Houston.
Okay, we'll see you. Thanks, everybody.